everyone. It's time for another episode of Mayhem in the Markets, brought to you by Traderade.com, where we help investors and traders of all skill levels learn more about macro, fundamental, and technical analysis so they can improve their consistency and find their edge in the markets. First up, we have big bets against Treasuries. The amount of short contracts out there are near records, if not the highest we've ever seen. And it's amazing if you really think about the type of positioning that's going on. It suggests that people think the Fed's going to be much more aggressive than they really are, or at least it could be some kind of hedging against long Treasury and other fixed income positioning that's been put on. But this is not normal, and it could have a reflexive response in the other direction, particularly with the type of strength we've seen in the Treasury markets of late, and perhaps because of the lack of debt issuance from the government as they approach the debt ceiling issue. The debt ceiling is something that's a manufactured issue. That's to say that the government is a self-imposed this debt ceiling, but every time it comes up, it does create some legislative kabuki theater, and that tends to introduce some volatility in treasury markets. And with this kind of short positioning, we might see some of that fireworks, and really in both directions, both, yields up, red alert, but also treasuries being bid well and yields going down, which is generally good for the markets, especially in 2022, where treasuries and stocks enjoyed the highest correlation they've seen in quite a long time. I want to say since the 90s. Next up, we have short covering in equities has been massive. This is the highest short covering that we've seen really since 2016. And this is extraordinary because it shows us kicking off this year with the sort of short covering that's reminiscent of 2021, really. Like, you remember January, early Feb 2021 when the market was flying? That's what this feels like. It's not natural. A lot of really bad quality parts of the market are flying higher, and that's not what you want to see. Really, if you're hoping this is the start of the bull market, at least of a new one, as many people seem to think, this is the opposite of what you would see during that type of situation. You would see stronger leadership because investors that are really optimistic are going to go to the parts of the market they want to hold through the bull market. And that's not going to be Carvana or GameStop or AMC or any of these other companies that are not doing so well. And I don't have anything against these companies. I just know that when the most shorted stocks are up about 40% on the year, and ARK is similar, that's not really what you want to see, right? You probably want to see some of the things that really suggest that people are looking for value, that they're looking for opportunities, not that they're buying the things that were beaten down the most and shorted the most in these episodic options-driven rallies. And I think that's something we should be paying attention to because options volume is hitting all-time highs. This is the most we have ever seen. So when we talk about the mania during 2021, we can see it here on the chart, right? And we can see the other sort of options-driven rally we had later that year. That was also not normal, and it didn't have a happy ending. In February of 2021, we saw the most call premium bought ever. And that led to a dislocation, particularly of the types of stocks where those calls were being bought. A lot of growth stocks, SPACs, EV stocks, Chinese stocks, things like that. Then we saw similar in November of 2021, where the most call premium was bought ever at the time, and the most put premium was sold, sort of positioning, suggesting people thought this market can never go down. What's happening right now puts that all to shame. It is absolutely absurd. It is dangerous. And I think a lot of people are going to get caught on the wrong side of this because the level of bullishness right now, and quite frankly, the level of naivety necessary to believe in that bullishness is categorically off the charts. And I get it. The price action's been great. Look, I short-term trade too. I don't fight the tape. I also run a long short book for my hedges in my, swing trade portfolio. And I'm happy to take advantage of all this, wild price action. It's great. It is. But it's not normal. It's not natural. It's not sustainable. And for people that are getting very bulled up here, I'm not going to give you any financial advice. All I'm going to say is I'm being very careful. And I've been through several markets, several cycles, And this is very unnatural, very unhealthy, very dangerous. It's not going to lead to good things. I could, of course, be entirely wrong about that. But when options are leading the way, and these are short-term contracts, most of them are 0 DTE, but we're still seeing people, buy out in days and weeks as well. That's not a commitment to a position. That's just a commitment to an idea of where price may go in a short period of time. And I think that we need to take that into consideration, given that liquidity is drained out of the financial system, rates have risen, right? There are offsetting factors with some of the short-term flows from the Bank of Japan, Bank of China, Treasury General account. Those are not long-term. That doesn't create a new bull market. What it does is it sets us up for a disaster for people that have gotten very bullish. A lot of bears have been blown out and have been hurt. Short positions, certainly in my long short book, don't look very happy. But let's zoom out a little bit. What has changed that suggests that we're going into this new paradigm, this new bull market? Have valuations become objectively cheap? No. Maybe there's pockets of value in the market, but by and large, the market's still pretty expensive. Have we seen a great de-risking event that suggests that there's real pockets of opportunity because people have gotten too scared? No, sentiment's been washed out, but positioning has not. Households are still near record long levels of long positioning. Have we seen the Fed meaningfully begin to reintroduce that lifeblood that financial markets need, liquidity and lower rates? No, quite the opposite. They continue to run down their balance sheet and tighten rates. Are we closer to the end of that hiking cycle? Sure. But that's not usually, the last 6 bear markets, they didn't bottom until the Fed aggressively pivoted. Not just the initial cut, but aggressive easing. Are we in a recession? You could argue we're probably starting one, but we're not technically in one, and markets tend to bottom in a recession. So I still feel like there's room to the downside. My outlook is that we do make a new low before we make a new high, and I think that new low is made in the not too distant future. And what this is all setting us up for is something that could be rather unpleasant. So it is something that we track at Traderade. We really look at market conditions. We analyze what we think is going on and driving the markets. And this is a phenomenon I will continue to investigate and share with our membership, whether it's on our Discord server or on our website. But I do want to just put this out there to the broader public. This is not natural. This is not normal. The combination of the short covering chart you just saw and this options chart is dangerous. Now let's bring up the next one. Because we need more evidence, right? I'm driven by information. I think it's very important to be well informed in these markets. Information is power. What is the information telling us here? Well, on screen, we have the February 2021 options mania, the November 2021 options mania, which is this middle spike here, and then the current options mania, right? What does that tell you about sentiment? People are insanely bullish. This is euphoria. And when people are this much loaded up onto one side of the boat, it does make it more likely that the boat could topple over. So yes, I do understand, if you're retail in this market, it looks great. There's all these very fun names that are rallying, all these, growthy and techie stocks, and we feel like we're in this new paradigm with Chat GPT and AI is exciting again. But there's nothing in here that is going to be durable. These gains are likely to be short-lived. And I think that the whole situation that played out with the Fed last week is actually not a good thing. To me, it suggests that the Fed is starting to become a little bit concerned about what they're seeing in the banking system and the broader economy. And if the Fed does pivot, remember that after the first pivot, the market tends to lose another 15 or 20%. So we're not, if you're hoping for a pivot, you're really looking for a better sale, which is fine. Just be mindful of the historical trends, that the first pivot isn't typically the bottom. We might get a rally into it, but it might be a stick save rally. Sort of like we saw before the great financial crisis and in other periods of the initial easing cycle, not putting in the bottom. It was really after the Fed got more aggressive that we started to see the market really bottom out. So this type of call buying, it's not a good thing. It really is a dangerous phenomenon. I've never seen it end well. I've watched options extremes ever since they became such a favorite that people were playing them constantly. And I'm just very concerned about what I'm seeing. This is the sort of stuff that when you see it, red flags and sirens go off in your head, because it's telling me everyone's getting very long, that the level of bearishness out there has been, thoroughly discounted. And now we're in a very extremely, to the point of danger, level of bull market. And look, that doesn't mean it can't go higher. I just think that the risk now is thoroughly to the downside. Next up, SPX options notional value trading hands daily has hit a record recently. A record of over $1 trillion of notional value changing hands every single day. And almost 50% of that volume is going into options that are expiring in SPX in 6.5 hours or less. Think about that. About $500 billion of notional changing hands to expire in 6.5 hours or less every single day. That is not only extraordinary, but it is not good, because we are in a situation where, quite frankly, the options market is having an enormous, inordinate impact in an already illiquid market. The illiquidity allows that market to move the underlying, or in this case, the S&P 500 index significantly. And I am quite concerned that just amplifies risk in either direction, but particularly the downside, because most of these options have been used to lift the market with leverage and very short-term exposure. And if you think about it, with this type of options exposure, you're not running any overnight carry cost, right? If your options, in the case of about half of them, are expiring in 6.5 hours or less, there's nothing to record on your books at the end of the day if you're an institution. And there's no margin cost to carry because you're converting that to cash. So that's a big issue, because these markets with CBOE allowing expirations pretty much every single day have created a loophole. You don't need to worry about the Fed because your cost to play with leverage is the same, right? If not less. You're not paying a carry cost to carry futures or longer dated options overnight, anything over the cash position you have in your account. Instead, you're settling into cash before the close of every day, and you're done. And you, therefore, are able to play with leverage without margin. And I think that's what makes us so attractive. I think that's why we've seen such an increase recently when rates have been going up. But I also think there's some shenanigans going on behind the scenes. And I'm working on some coverage for Traderade where I will be talking about exactly what I think is going on. And you won't want to miss it. Next thing, Tesla has accounted for 7% at times of daily options volume. Now, Tesla is not the biggest company in the world, right? Yet it's trading more options than Apple. That's very, very concerning. And this is part of what I call a delta-driven squeeze, because you've got near-to-the-money, close-dated options buying happening, often same day, sort of like SPX. And that pushes the price around with leverage. And you just don't want to see that being the primary driver of upward price discovery. Yeah, it can create this sort of squeezy environment, as people like to call it. But it's dangerous because, like with everything else that's driven by options, it's short-term, it's time-sensitive, and generally it's a pocket of hot air underneath price when it moves like this. So I would be concerned. It doesn't mean Tesla has to fall significantly. It means that the left tail risk is growing the more of this sort of stuff goes on. And this is more options activity than we saw during 2021 in the sort of heyday of Tesla being the most popular traded options on the market. This is dwarfing that significantly, almost by 100%, basically by about 75-80%. That's incredible. And if you think about it, this is also a situation where, the company has had some decent earnings that have come out, but the type of options buying that's happening here is incredibly, incredibly lopsided. It's much, much more on the call side. It's very short dated. It's all about pushing price. And I would just be a little bit concerned if the majority of upward price revisions are being driven by options. We know what happened last time to Tesla or Upstart, Affirm, Asana, Cloudflare, and some of the other rock stars of 2021 were driven by these episodic delta squeezes. For Tesla, it was for the better part of the year until November when it all fell apart. And why did it all fall apart? Because the options buying stopped as market conditions deteriorated. So, if I was in a Tesla trade long right now, I would be looking to capture some profits because it's been a great run from, 105, 109, whatever it bottomed at. And it's all driven by this options activity that if it does end, there could be a significant pocket to the downside. So again, that's just me. There's never any trading or investment advice offered here, but I do like to give my own opinion about these things in case it might be helpful for others. The market is now pricing in Fed funds of 5.25% by May. This is an increase of 25 bips. It's interesting to see that because for a while the market was saying, no, we're just going to peak out at 5%. It does look likely that that next 25 bip hike is going to be in March. And the final 25 bip hike of this cycle is projected to happen in May. Now, that doesn't mean it will happen in May, and it doesn't mean that it's going to stop in May. We could see them pause in May and hike later in June, or we could see them hike again in May and June, or we could see something else entirely. We don't know because the data is really what's going to drive the Fed here, so we need to pay attention to the data. But Powell did display a noteworthy change of character during the last meeting, and I think that's something else that's worth paying attention to. It does feel like something is making him a little bit nervous. If you're interested in what I think it is, visit my new project at macrovisor.com. And at macrovisor.com, you can check out the latest research that we posted. It's a project that I started with my partner, Aisha, and we're going to be covering deep dives in the world of macro. We'll be looking at themes, trends, sectors, industries, and much more, and then diving all the way into the micro data. Next up, the Chinese consumer has no confidence. I mean, look at this. This is just absolutely astounding. Anything over 100 is optimistic, so we can safely say this is not looking very optimistic at all. Now, the one thing I'll say about this is it's backward-looking data, it's sentiment surveys, so we do need to know where they are now that the country's reopened. Certainly couldn't go terribly lower, right? I mean, it's just gone off a cliff, and you can't blame them. I mean, look, if I was locked up for that long and dealing with, the sort of onerous restrictions of the government and all the sort of forced testing and other nonsense that was going on, it'd be quite demoralizing, as would be the lack of work, the lack of financial and economic security. All the things that happened there had to be incredibly jarring. So this is not a surprising chart, but it does leave a lot of room to the upside. If things really start to get back to normal in China, whatever that is, it does suggest that there could be some opportunities there. So it's something to pay attention to. Amazon just had its largest loss ever, which is incredible. I think that this suggests that maybe, just maybe, hear me out, Rivian wasn't a good idea. I'm just putting it out there. Why? Because a lot of this is that there are also just way too many investments in the company. The company got very, very excited during the COVID period where we were flush with liquidity, where consumers were going bonkers buying stuff on Amazon because they weren't going out to stores. And unfortunately, that was more of a temporary trend. And, the other side of it is AWS is slowing. Growth in the cloud is slowing at Microsoft as well. This is not what you want to see for the entire cloud ecosystem. And it also suggests that there's more slowness for Amazon to come in the quarters ahead, in my view, because AWS is not done on the declining, on the slowing, because there's more businesses that are slowing their spend. But on the other side of that, I think there's other things that are going on here too. I think that the e-commerce side of Amazon is due for further slowness because the consumer is struggling. 40% of households are struggling to pay their bills. 2/3 are living paycheck to paycheck. There's not a lot of appetite to buy things that people don't need. Now, sure, people can buy groceries and necessities and staples on Amazon, but that's A, not really going to give them too much margin, and B, it's a much smaller part of their total business. So I am concerned about Amazon. This is a company that's been struggling for some time. It really did not have a good year in 2022, and it makes sense with, AWS beginning to slow, and I think there's more slowness to come, but also e-commerce really slowing. So this is a company that I think has sort of fallen from grace. I do believe at some point there will be a great opportunity to buy Amazon, possibly at a meaningfully lower price. And look, I think that they have some great technology. I think they're kind of an irreplaceable part of the economy. They are the nation's largest employer, but I don't believe that the pain is over yet. And here's that chart. 40% of Americans are having difficulty paying bills. This is incredible. It's worse than it was during COVID, and it's a very, very difficult time for so many people. If this many people are struggling to pay their bills before there's any type of potential recession, what's it going to look like when things get tough? There are 1.9 job vacancies for every unemployed American. This is not a labor market that is loosening. This is not a situation that gives the Fed comfort, particularly with non-farm payrolls coming in at 518,000 versus a consensus that was under half that. It tells us that there is still pockets of strength in the economy that could lead to higher than expected demand, and that could slow the Fed's war against inflation. It would be truly remarkable if maybe there would be some consideration of adding supply to this market. How do we do that? We have a better labor policy for labor coming into this country, a better immigration policy, I should say, right? We need a labor-centric immigration policy. We have 2 jobs for every 1 unemployed person. And the Fed has said, well, maybe we'll just destroy the wealth of retirees and get them back in the market. I mean, that's one way to do it, and maybe they will. But you know what would be better? Is to give people all over the world that have the skills, that are eager to come to America, a chance to work hard and realize the American dream. Because right now, we need that. We need a broader labor market, and our demographics are deteriorating. We have a larger group of aging people in this country. They're not being replaced. Population growth has plateaued and is slowing significantly. And I don't believe that's going to be something that materially improves where you have, a large contingent of young adults living at home with family. Something like 15% of 18 to 29-year-olds. So that suggests that the birth rate is likely to continue slowing. The Baltic Dry Index has discounted most of the post-COVID crash gains. This is suggesting that the global economy is slowing. Some of these supply chain constraints have eased significantly. This is a great sign overall, but it's also one that with the rate of change we've seen from peak to trough, it does suggest that the global economy is slowing pretty meaningfully and maybe leaning more towards that recessionary outcome, at least for some of the countries out there that haven't yet experienced one. I do believe China is probably ahead in the credit cycle as they were during COVID as well. Since it hit them first, they eased first, they kind of built that new bubbly bull market first, but that doesn't mean that the rest of these countries are going to escape, particularly these developed countries that have some pretty important systematic imbalances, sort of economic challenges to overcome. And eventually, speaking of economic challenges, the macro will matter again. Investment grade spreads are still resilient while leading economic indicators are tumbling. Typically, those leading economic indicators matter a lot towards spreads because guess what? It's harder to pay down debt when the economy is slowing down. When you see more challenging business conditions, particularly coupled with rising rates and constrained liquidity, it's likely to cause more challenges in credit markets as borrowers are less able to pay down their debt. That's the exact sort of environment that we are seeing, and yet it's not priced in. I'll go out on a limb here. I think it'll be priced in. Next up, we've got Goldman Sachs economists believe the worst of inflation is behind the U.S. Whether that proves to be true or not remains to be seen. It does seem to be the case in goods inflation, which has dropped meaningfully. Core services inflation's been resilient. My partner Aisha has talked about how we may see some relief there in May-June's CPI data as the owner equivalent rent survey begins to show some of that data. There's a lag in it being visible, but begins to show some of that data, that disinflationary data in rent. And that would be good. That would be good. But at the end of the day, the structural supply and demand dynamics that made this inflationary period possible have not been resolved, as we saw previously in the labor chart, right? But also in the energy, raw materials, and agriculture markets. There are just essentially a lack of investments across all these markets that lead me to believe that these challenges will rear their ugly head again as soon as we get into the next new credit cycle, and they'll do so from a place of higher prices, which makes it even more difficult. The yield inversion between 3-month bills and 10-year notes is the deepest in over 3 decades. This is suggestive that the next recession could be quite painful. It's also something to watch not when it's inverting. The inversion matters, the duration of inversion matters, but the steepening is typically what prefaces the period of challenging economic times. As we can see on the chart, the dot-com crash and the recession that followed was ushered in not by the inversion, but by the steepening. Similarly, the great financial crisis, and look at the length of inversion prior to that. It was also ushered in by the steepening. And then finally, the COVID crash recession. We did see this sort of was led into by a steepening. We did have an inversion during that time because everything went bonkers. I mean, everything went bonkers. The oil went negative, the market crashed. I mean, it was just absolute insanity. But here we are now with the yield curve deeply inverted more than it was in those 3 prior occasions. What does it mean? I think it means the next recession could be a bit messy. I think it means the bond market is thinking the Fed is making a pretty significant policy mistake with the amount of debt and the underlying fragility of the consumer and how much they drive the economy, such that we could have a rather meaningful recession. Now, that doesn't mean that the bond market is 100% right, but I think it's right enough. I do believe the chances of recession this year are much more likely than not having one. Question to everyone out there, earnings estimates are falling. Will they drag the market lower? They typically do when they fall. Sometimes they're leading, sometimes they're lagging. But what's important here is the market seems to be completely disconnected from reality. We're looking at a market that's contentfully and gleefully ignoring dropping earning estimates that are also, we're seeing actual earnings that are dropping. Apple with a double miss, Google with a double miss. A lot of this earnings deceleration is rather disconcerting. Amazon with the largest loss they've ever had in the company's history. There's a lot of things that are going on underneath the surface here that suggest the economy is not doing well. Whether we look at the macro data or the fundamental data or the guidance, it says that, well, things could get worse before they get better. And I understand the optimism, and I want to be very optimistic too. I'm optimistic by nature, believe it or not. But I also have trouble being too optimistic when I don't see any of the sort of drivers for that. Now, that doesn't mean that we can't continue to move higher in the market for the short term, but I think in the intermediate term, it's going to get much more challenging before we find a durable bottom. And one of the ways we'll find that durable bottom is when earnings really start to kind of trough. And we're not at that point yet. They continue to decline here. Delivery companies might be in trouble. Look at Grubhub, DoorDash, Uber Eats. The average decline here is pretty significant. It's about 27%. I just think that, when you're looking at this kind of data, it's telling you that the consumer's in trouble. People don't want to eat out less. They don't want to order in less. They are doing that because they don't have the funds to eat out more or to eat in more with delivery. So, last slide from my deck here, the meeting probabilities. We've seen 5.25 now priced again, as I suggested in the prior chart, with the peak being in July, the first cut happening in September, the second cut in December, for a total number of cuts of 2 with 50 bips coming off, ending the year at upper bound terminal rate of 4 3/4 with a peak of 5.25. Now, if we get there or not will be interesting to see. I personally think we might move a little higher than what this is projecting. This has been kind of moving with the market. The jobs data on Friday pushed this up by 25 bips, and I think that it makes sense with the jobs data being that strong. It also begs the question, what will Powell say on Tuesday about that? Will he walk it back? So thank you everyone for watching. I really appreciate it. It's a lot of fun to make these. If you enjoyed this content, you'll love what myself and my partners at Traderade.com share really every day, especially if you look at the Discord and the website in combination. We focus on macro, fundamentals, and technical analysis while also covering the psychology of trading and investing, the dynamics of options and futures markets, and much more. Our goal It's to help traders and investors of all skill levels. We want them to become more consistent, well-informed, and help them find their edge in these challenging markets. Join us with a 20% discount code on me using the code Mayhem20 and get some cash back as a courtesy. I hope to see you at Traderade.com, and I look forward to seeing you on the YouTube regularly as well. Look forward to seeing more content from me on MacroVisor, and if you don't follow me on Twitter, check me out, Mayhem 4 Markets, Mayhem number 4 Markets. Thank you again, everyone, for tuning in, and I'll catch you soon.